The US economy has manifested its strength much better than expected. Judging by the latest reports, inflation is still raging in the US housing market, and the number of orders for durable goods is increasing. But the market's main focus this week is consumer inflation data that will be published in the United States on Friday. Investors have already revised their expectations for rate cuts by leading central banks. On the back of this forecast, the US dollar is on a track for solid gains for the first quarter, but today Japan's financial authorities tried their best to save the yen from an even worse failure. This time, the Bank of Japan, the Ministry of Finance, and Japan's Financial Services Agency met during trading hours in Tokyo to discuss the critical situation. Following its results, Masato Kanda, who is responsible for the government's monetary policy, said that he does not exclude any steps in response to erratic movements in the exchange rate. Of all the currencies in the dollar basket, the yen suffered the most under the weight of the advancing greenback and tumbled to the lows unseen since 1990. Such a dismal slump prompted Japan's top officials to make joint efforts to support the national currency. As a result, they managed to knock the rate down from a dangerous 152 to 151.10 against the greenback. The yen has already weakened by more than 7% since the beginning of the year, and the decisive steps implemented now against excessive currency fluctuations look like temporary support. Moreover, the US dollar maintains a bullish bias. Its index jumped by 3% over the first quarter. Some of the traders who have been going short on the US dollar apparently closed their positions and thereby helped the greenback grow even stronger. The dollar index is still trading above 104 points today in anticipation of the US GDP report on Thursday. The highlight of the week is certainly the PCE price index, which is due on a Friday. Analysts do not rule out a new rally of the US dollar in the last days of March before a long holiday weekend in the United States and Europe, and the main driver of the greenback will be the US economy, which can cope well with the elevated interest rates set by the central bank. Interestingly, some Fed officials' comments are now deviating from the official rhetoric voiced by the Fed Chairman Jerome Powell when he spoke about 3 rate cuts this year. Yesterday, Atlanta Fed President Raphael Bostic said that the regulator should act potentially and that he now expects only 1 rate cut this year. Fed Governor Lisa Cook also advocates for a cautious approach to ensure inflation returns to 2% on a sustainable basis. On the back of differences in the forecast, the US stock market also lost direction. In the early New York session yesterday, the S&P 500 rose in a confidence, but it closed in the red, and today in the early trading hours, Wall Street bulls have not yet shown much vigor, pushing the S&P 500 inside the bearish corridor of 5,203 and 5,235 points. However, then the index very quickly perked up steam. Perhaps such optimism can be explained by the fact that today China's President Xi Jinping met with the American entrepreneurs and scientists. Beijing is trying to attract more investment into China's economy as well as maintain relations with the United States. China's growth prospects are bright, and we have confidence that China's economy has not yet reached its peak, Xi Jinping said during the meeting. Meanwhile, traders are trying to assess the agenda of major central banks for the next 3 months and find an answer to the question: which of the major central banks, the US Fed and the ECB or the Bank of England, will be the first to cut interest rates this year? Monetary authorities in Europe still look dovish in contrast to their colleagues from overseas. Moreover, revised inflation expectations in the euro area were once again lowered, and this means that the ECB will likely start cutting its interest rates earlier than the Federal Reserve. So, the euro-dollar pair, even despite the empty economic calendar, today is trading lower in the intraday corridor over 1.0810 and 1.0840. The pullback from the support level of 1.08, which began on a Monday, was interrupted yesterday near 1.0850. At the same time, the single European currency is on a track to a 2% fall in the first quarter. Now, euro sellers have come to the fore again. Apparently, the bears intend to push the price closer to 1.08. If they fall to break through to this support level, the euro-dollar pair will again get stuck within the range of 1.0800 to 1.0850. For an upward scenario, the bulls should try to break through the upper border of this range and consolidate above 1.0850 at the end of the day. Only in this case, the euro will grasp a chance for a further recovery. Oil prices today do not have much chance for growth at all. On the contrary, yesterday's reports from the American Petroleum Institute showed an increase in the US oil inventories by 9.3 million barrels and thus automatically enabled a decline in the oil prices. So, the new trading day for Brent began with a downward gap. That's the opening price on a Wednesday was 1% lower than the closing price of the previous day. The Brent price tried to win back at least a part of its losses, and still the sellers dominate the oil market today. Moreover, if a Brent crude settles below $85, it will reinforce the bears' chances of pushing the price down. However, if the 1% gap is closed at the end of the day, then the intraday corridor over 85 and 87.5 may become relevant again. You have watched a market review by InstaForex analyst for Wednesday, March 28. Subscribe to InstaForex TV channel and we keep you updated on all market developments. Feel free to ask any questions and leave your comments and see you online tomorrow.